and they've done damage, derailments and leakages and fires have occurred too many times. There are companies that are building newer, safer, stronger oil tank cars. That's the most prosaic business in the world. It's just lots of steel getting welded together. But there's a demand. And the companies that manufacture railroad tank cars are going to have to replace the whole current fleet over time. So they're going to have growing businesses for years to come. Then there's the new things, of course. The smartphone, of course, was the most dramatic of our lifetimes. But there will be others, and you just got to keep your eye on them. Keep your eye out for them, looking for them. We talked earlier about the cyclical plays. The one-time stumbles. There are lots of very good companies, very investable companies, that every once in a while stumble. They'll report a bad quarterly revenue and or earnings report. And the stock will get hammered. The market has really no patience for anything less than perfection much of the time, because there's a trader fraternity, and then there are people who just get scared and rush to dump their stocks. So when you get a stumble by an otherwise good company in a good area, all the metrics on the preceding page, and you get a chance to buy it 20, 30, 40% cheaper than it was the day before yesterday, you want to give a hard look. Make sure that the fundamental long-term investment argument is still in effect, and that the problem is going to get resolved. And you've got a buying opportunity. But I'll give you one more little aphorism, and that is, there's no such thing as a one-quarter problem. And what I mean by that is, no matter how good the company is, if there's a stumble, it's probably going to take a couple of quarters to fix it and get back on track. So you don't have to rush the day they announce the disappointing numbers. Give it a little time. Let those who want to get out. And wait till things quiet down and the stock price starts to move sideways. Yes, sir.
So I've seen situations where a company's earnings would do well, but it would still go down, and sometimes the earnings would be poor, but it would still go up. Can you explain what's going on there?
Oh, yeah. Well, I think we did earlier today. If you've got companies that are still doing well, but maybe not as well as the consensus of the market expected, stock's going down. If you miss the numbers, the stock's going down. Missing the numbers, every company of any substance is followed by 20 or 30 Wall Street analysts from different banks and investment firms. And together they will arrive at consensus estimates for revenues for this quarter and for earnings. And when the company reports, yesterday Alcoa reported its results for the first 3 months of this year. Alcoa, the big aluminum company. Earnings were much better than expected. And they were very depressed, but much better than expected. And management made some very bullish comments about the prospects for the rest of the year. And the stock went up a lot today. Well, a couple of percent, which for any company is a good move on one day. So if you miss the numbers, you're going to get punished severely. If you do badly, and you've raised a very interesting point, if your results are poor and your stock goes up, either there was some hidden reason that masked the good numbers and showed depressed headline numbers, or the market says, aha, that's the end of the bad news. From here on, it's going to get better. One or the other.
And do you recommend holding a stock during earnings? Because I was told not to do that.
Well, you're raising another interesting question. Look, we have a portfolio of 30 stocks that we own. We're not going to sell them the day before they report their earnings. We own them because we think there's a 3 or 4 year play. Okay? More relevant, forgive me, more relevant than the question you asked is, am I going to buy ahead of the earnings? And we do not. Okay? We don't buy ahead of the earnings because A, there's the risk of a disappointment, which is not trivial. It's not 50%, but it's not trivial. And B, there'll be a whole group of people in the trader fraternity who will use good earnings as an opportunity to sell the stock to take profits. So we tend not to buy ahead of a quarterly earnings report. All right? When there's a management change, the board of directors is saying, in effect, we think that this company can do better. We don't like the guys who are steering the ship. We're throwing them out and bringing in new players. More often than not, that's a good place to start looking for a potential investment. Likewise, if there's a spin-off or a company breaks itself into two parts, spins off a division into a freestanding company, or breaks itself into two parts, the insiders, the board and the management, know what they're doing. They have figured out that two separate entities will be worth more than one. And so we look very carefully at spin-offs and splits into a couple of entities. It's a good place to start hunting. Bankruptcy exits. There are a lot of companies in worthwhile businesses. They may be cyclical businesses as opposed to stable demand businesses. But they're good businesses. But the companies got overly leveraged, too much debt. They couldn't service the debt, and they went bankrupt. Now, in a bankruptcy, to keep it very simple, the stockholders get wiped out. Whatever piece of stock paper you own is now wallpaper, worthless. And in the reorganization, the debt holders, starting with the banks and then to the senior debt and then junior debt, it's all spelled out in covenants that are written when the debt is issued. The debt holders get new common equity. They become the new owners of the company in different proportions according to the deal that the creditors committee works out among itself and the judge in the bankruptcy court puts a stamp of approval on. When those shares, the debt holders typically are not interested in continuing to hold common equity. They're in the distressed debt business. They bought the debt at a huge discount from its face value. And now they've made a profit, 20, 30, 40, 50% profit, as the debt was replaced with new common equity. But now the company is back in business, debt-free, and when those bond buyers or distressed debt buyers get their equity, they tend to sell it. And we tend to look very hard at buying it because they're not interested in the future prospects, but we are. And we can often buy companies on the cheap. So that's another one. And finally, at least on my list, there's industry structural changes, particularly industry consolidations. Years ago, we had a heck of a lot more airlines flying than we do today, and the airlines were cutting price every day to try and fill up too many seats. They went through a period of consolidation where the stronger carriers bought the weaker ones. And the last big one happened just this year when US Air took over American Airlines. American Airlines was actually in bankruptcy at that point. And a lot of people had to sign off on this deal. But the moment that deal was announced, we said, we're only going to have 3 airlines left in this country of any importance. American, which is what they call that combined company, United, and Delta. And we bought them. We bought American and we bought Delta. And we've done very well, and I expect we're going to do even better over the next several years, because when you're down to 3 players, you're going to have discipline in terms of pricing and discipline in terms of capacity additions. The airlines are not going to be overexpanding. They're not going to be cutting price to fill the seats. This industry is going to start, and indeed already has, to make real money. Good money. Yes, sir.
Is that a sign that companies that make money selling airline tickets, like Priceline, that their business is in trouble? If the airlines are so consolidated, they don't need the middleman anymore, right, to sell their...
That's a very good question. We don't own Priceline. I have to confess that I missed it badly, because it's done super well. So, mea culpa. But I think you raise an interesting question, and I don't know the answer to it. But it's worth further investigation. I'll bet that when they report their first quarter report, they'll have to say something about that.
Right.
When they have the conference call, which you can listen to, and which a number of Wall Street analysts will be asking questions on, that question's probably going to come up. So you've got a good one there. I don't have an answer, and I probably won't bother listening. I've got the airlines, but I wish I'd owned Priceline the last few years. Yes?
I think while they two combined, I feel like a lot of Southeast Asian airlines are expanding. So maybe that could balance out the fewer tickets in America. So these
Who are you thinking of in particular?
I don't remember, but I know that, for example, Etihad, Emirates, they put in a lot huge orders this time around at the Dubai conference. So them, I mean, those are huge. But then I know there are a bunch of South. I don't know from the top of my head, but I know there are a few which are expanding.
Look, first of all, there's rapidly growing demand in Asia and in the Middle East for airline travel. But when it comes to Americans, for flights originating here, I'll be on the lookout, since I own American and Delta, for any fraying around the edges. But my guess is that the typical American businessman is more likely to fly with one of the three big carriers. That's not a guarantee, and you've raised an interesting red flag that has to be watched. But as long as we see what is called PRASM, passenger revenue per available seat mile, that's a critical power metric for the airlines. As long as we see PRASM rising, we're okay. Yeah.
So, when you, as an investor, when you're looking at the metrics of some of these companies, do you have access, like, to some of the bank metrics, such as, American Airlines or U.S. Airways rather, they bought maybe an option price of 80 barrels of oil that they're going to use. Do you have access to information? And
They give it to you.
They give it to you. Okay. So
They give it to you.
So you have this.
They tell you, all the airlines tell you what their fuel costs are.
So you have this information. Do you
Oh, yeah.
use this metric as a way to gauge maybe it's going to be volatile. Maybe they might lose money or gain some money, or what do you do with these metrics? With those in particular.
You're raising a whole set of issues. Delta happens to have its own refinery in Philadelphia, which supplies some of its fuel needs, but at least gives them a little advantage over the other carriers. Although that refinery so far has been a money loser for them, but I think they've got it fixed up now. But the airlines will all tell you what their projected fuel cost is. That's only one, albeit very important, but only one part of their cost structure. Labor, depreciation, and interest costs are also important. And the most important thing for them is load factor. What percentage of the seats are filled? And the load factor will translate into PRASM.
So President, this is basically the most efficient way of
It's what they on average what they sold every flying seat for.
So it would be
And if all the tickets for a given flight were $100, but only half the seats were filled, you would have a very bad PRASM for that flight. Okay, so let me tell you, these boys have very sophisticated yield management systems, banks of computers, and I don't know whether you realize it, but airline fares aren't constant. They change every day and sometimes during the day, because they are maximizing yield on every flight. Hotels do exactly the same thing. They have a limited capacity, and they're going to squeeze every drop of blood they can get out of it. Yeah.
Question about managers. You said that if there's management change, then there's a likelihood that good things are to come. There's a good chance of that. But what about when somebody's fired, but there's no replacement that's hired just yet?
Boards of directors don't fire people unless they've got somebody in the wings.
Yahoo, didn't she fire the
Yeah, she did. She did. She wanted the job. She's doing it herself. Melissa Meyer. Yeah, she'll get another puppet to sit in there, but she's running. She's the puppeteer here. Don't you kid yourself. All right, now we're kind of running low on time. I guess I would, on Roman 5, I would just tell you, you got to know your own objectives, your own personal objectives, what you're trying to accomplish. You got to know how much pain you can handle when things go against you. And so you have to decide how much you're going to diversify and among which sectors. I can tell you that we try to buy a position, or typically buy a position that equals 3% of the portfolio's value at the time we buy it. So if we had a $1 million portfolio, we would buy $30,000 worth of whatever the new idea was. So we'll run with about 30 stocks, give or take. Depending on your risk tolerance, you may want to have a lot of sectors of the economy represented, or in our case, we only have 5 or 6 sectors of the economy. We're willing to make big bets. We have a big bet on the airlines. We have a big bet on airline construction, parts and the like for airlines. We have a big bet on financials because we see interest rates going up. We have a pretty good sized bet on the energy industry, whether it's finding oil, producing oil, or transporting oil. So we're pretty concentrated. We don't try and be across the board. We own no utilities, no telcos, no REITs, no consumer goods to speak of. We have our view of the world, subject to change, but that's where we concentrate. But we have buy and sell criteria. And under sell disciplines, I point out one silly little thing that I'm sure you've already thought of, that if you lose half your money in a stock, you have to double your money to get back into even. If you lose half your money in a stock or in your whole portfolio, what do you think the chances are that that stock or that portfolio is going to double anytime soon to get you back to even? I'd say somewhere between slim and none. Okay? So you've got to know your risk tolerance, and you've got to have a sell discipline. There are canaries in the coal mine for the market and for individual stocks, and you've got to be alert to them. And we say if something's down 20%, you're either willing to buy more or you better sell it. That's our sell discipline. Yours may differ. I'm not saying we have any answers here. Also, we could spend a whole day on trading patterns, but if you keep an eye on what the chart looks like, it'll help you a lot. When we get something that goes parabolic, we say we love this company, but we don't have to love this stock anymore. It's treated us very well. Let's find something else. We'll sell it. Now, when you're managing a portfolio, the question is, what are you going to compare yourself to? Well, there's dozens of different benchmark indexes. We use the Standard & Poor's 500 stock index, and our clients know that we're trying to do better each year than that index. Better on the way up and better on the way down, particularly on the way down. Alpha is a term that reflects the percentage that an individual stock increases above the market as a whole. beta is a calculation revised frequently, certainly at least monthly, of how volatile a stock is relative to the S&P 500. If the S&P 500 goes up 10% and this stock goes up 5%, it's said to have a beta of 0.5. If the market goes up 10% and this stock goes up 20%, it's said to have a beta of 2.0, and of course 1 to 1. There is one more tool I'll leave you with. There are a whole bunch of evaluations that big clients use to figure whether you are making your money by taking too much risk or not relative to their risk. And they will look at the following little equation. The return you made on the portfolio minus the risk-free return, that's the treasury return, let's call it 3% just for a number. It varies, of course, but right now let's call it 3%. The real risk-free rate is actually essentially 0 at this point, because most of what we really call risk-free are 3-month treasury bills, and they yield almost 0. But let's say you make 20% in your portfolio this year, minus 3% leaves you 17, and you divide that by the standard deviation of your portfolio calculated monthly over the year. How volatile was your portfolio? If your standard deviation was 20% within a year, which would be horrific, then your Sharpe ratio is 1. Excuse me, I'm sorry, take that back. Less than 1. We had 20 minus 3 is 17, divided by 20. You had a Sharpe ratio of less than 1. Bad news. Your client will likely say, you had a great year, you're fired. Okay, I've been there. You had a great year, you're fired. You took too much risk for my blood. Another way to look at it is, how did you do in your up months? And how did you do in your down months? Absolutely, and relative to the benchmark. Again, the S&P 500 for us. So, that's a whole science. Sandra, we could probably spend another lecture series on benchmarks and portfolio construction, but I hope this has all given you all a feel for this. If any of you are thinking about working for Wall Street firms, I give you 2 pieces of thought. I won't call them advice. But if I were your age and looking for a Wall Street firm, I would want the firm to say to me, you seem to have pretty good background, and you seem to have a feel for this. We're going to teach you a lot about trading, research, investment banking, whatever it is. And you're going to work hard as a trainee, but let us show you what the career path looks like. If they can't give you that, get up and leave. You're in the wrong place. The other thing that I would urge anybody who's thinking about going to Wall Street to give second thought to is whether or not you'd be better off going into industry, working for some company, and becoming very knowledgeable about that industry, and then finding that your knowledge was in demand by the research department or the investment banking department of a big bank or a big investment management firm. Those firms pay a big premium to get people with specific industry experience. And in this day and age, with Wall Street shrinking, I think that's the best route in. So I leave that all to you. I hope it's been helpful to you. Okay. Good. All right. Thanks for coming.
I hope everyone's learned as much as I have in the past.
Oh, come on. You knew
Short
all this
lecture.
beforehand.
But if you could all join me in thank you, Stefan, for taking his time he volunteered to do this. So this is just for all of your benefit. And we've really benefited from your many, many decades of experience doing this. So think about all the classes you have taken to cover the amount of material that Stefan managed to do in just 4 sessions. So thank you so much.
Did you have that thing going?
Yes.
Oh, good.
Are we gonna have